Gentlemen, this is Professor Banks, and I'm here with the final video presentation for chapters 12 and 13, which are actually due together. These are actually repeats of the last two chapters that we had in Accounting 201. So we're going to deal with the cash flow statement and then financial statements analysis. So because they are basically a review of what was covered in 201, I always just handle these together as one problem set. So let's get started with the last piece of this. Obviously, cash flow statement is the last of the four basic financial statements, and it is really just an overview of the cash coming in and cash going out of a company. Two methods for preparing the cash flow statement. One is the indirect method. We took care of that in Accounting 201, even though we're going to walk through a problem that deals with that today as well. And then there's this direct method. The direct method is a bit more detailed, and as a result, it is the direct method that is recommended by GAAP, but it is only a recommendation. So you still find a lot of companies who still predominantly use the indirect method. The bottom line is you should get the same answer regardless to which one you use, and because the indirect method is easier, companies have tended for years to choose that method. Considering the technology that we have these days, the direct method is not really all that cumbersome anymore, but it does take a little bit more work to do that one, at least for the setup these days, because that's all it takes is setting it up, and then the numbers can, for the most part, crunch automatically. So we want to take a look at this first question. It is dealing with the Fortin Company, and it is problem 12-3A at the end of in the end of chapter materials here. We're actually going to look at this problem from both perspectives here. This first time through with question 1, we are going to prepare a statement of cash flows using the indirect method, just as a refresher for what we did in Accounting 201, because again, this is the way that most companies prepare it. When we go to problem or question 2, I should say, we will be looking at the direct method preparation for the statement of cash flows using the same information. I will say this: when you get to the homework, can't remember if these two problems are there, the same two problems are there again, but do note that the numbers are in an algorithmic format. So because they are two separate problems, you will likely have a different set of numbers as you prepare those problems in the actual homework there. I know we ran into that problem with another problem set in one of my other classes. So just wanted to make you aware of that. But let's take a look at the indirect method. Just a reminder here that the indirect method always starts with the net income. And as far as these two methods are concerned, the only thing that's going to be different between the direct and indirect method is the investing and activity section, are the investing and financing activity sections. The operating activity section is going to be different for each one of them. I think I just said that backwards. The operating activity section will be the only section that is different between the two methods. The investing and financing sections are identical. So they will be the same as we go from this problem to the next problem, which has you preparing it the direct method. So with the indirect method, again, we start with our net income, and notice again that we are given the income statement as well as 2 years worth of comparative balance sheet items. And this is because the indirect method has us taking the difference between the two to see whether or not there was an increase or a decrease in the current assets and current liability accounts. And we're going to use those to try to get to our cash flow in that operating activity section. But we start with net income. But net income does not have all cash items in it. And that's the problem we have with using this number and why we need to have a separate cash flow statement. So the 114,975, we'll drop that in. 114,975. And then the next thing we want to do is to go through and look at our income statement and see whether or not there are any items that were non-cash that you could tell up front did not involve a cash outlay. And if so, we want to make adjustments for those in our cash flow statement. Right off the bat, we know the first thing we always look for is depreciation expense. This could be depreciation expense, depletion expense, or amortization expense. All three of those are write-downs of long-term asset for how much of them we used every year. And we almost always see depreciation, and depending upon what industry the company is in, you may also see depletion or amortization expense as well. If you see either of those, you want to add them back. So first one here, we're looking at depreciation expense, and that expense, get my keyboard right here, is $20,750. Are there any other items that would not have involved cash? Well, we have the loss on the sale of equipment here in the amount of $5,125. That is not a statement of any cash that exchanged hands. It is just our method in accounting for making our books right, for balancing our books. We need to get this equipment off our books. Right now, it is on our books at whatever the initial cost was minus the accumulated depreciation. We have that information down here in item B. So the difference between those two numbers is what our book value was. If we sold it for less than the book value, we would have incurred a loss, and that's what's happening here. So we have the 46,875, 46875 minus 30125. That gave us $16,750 as the book value, just the difference between the cost and accumulated depreciation. We were able to sell this for $11,625 cash, and that is $5,125 less than we had it on our books for. So in order to clean our books up, we need to write off an additional $5,125. But that is not reflective at all of what happened as far as our cash is concerned. Cash for that transaction would have been $11,625. The other thing is it would not appear in the operating activity section. If you recall, we have operating, investing, and financing activities. The purchase or sale of any long-term assets is considered an investing activity. So we will see this $11,625, but we will see it in the investing activities section. This $5,125, we didn't write anybody a check for that, so no cash went out. We want to add that back in. And that's going to be the loss on the disposal of this equipment. And that is $5,125. There was a loss, so we want to add it back. If that happened to have been a gain, we would subtract it because it has been included in the net income. However we use that number in calculating our net income, we want to back it out. In this case, it was a negative, and we did not write a check for it, so we want to add it back in. If it was a gain, this would have been a positive number, and it would have increased our net income, and it almost seems like somebody wrote us a check for this. They didn't write us a check for the gain. Again, they only wrote us a check for the $11,625 as an investing item. Okay, I think that's it for items, for direct items that would not have had a cash impact. So if you recall from Accounting 201, not sure how long ago many of you had it, but we next need to go to our current assets, our non-cash current assets. So we're going to skip cash and go to the other current assets and take a look at the difference between the prior year and the current year. We're looking for whether or not these current assets increased or decreased. If they increased, an increase in current assets means that you bought something. So that's a negative where cash is concerned. That's how we interpret it, and it actually works out that way. So for example, in this case, there is an increase in inventory. That simply means that we spent money buying more inventory, so that is a cash outflow. It's a negative where our cash flow is concerned. If, for example, let's see, prepaid expenses went down. So there's a decrease in current assets. That represents an increase in cash flow. And I'll show you a little cheat chart in a couple minutes here. We're going to slide over to an Excel spreadsheet. And then we go to our current liabilities, and they work opposite. So they work opposite from the current assets. So with the current liabilities, whatever direction this change goes in is the same direction we see cash flow. So for example here, our accounts payable went down from 114,675 to 53,141. That is a decrease in the amount of 61,534. What that simply means is that I had to pay those debts off. I had to pay down the balance of that account payable. There's a decrease, so there's also a decrease in my cash flow. So any decreases where current liabilities are concerned would be a negative number on our cash flow statement. So any increases where current liabilities are concerned would be an increase in cash. Let's say there was an increase in the accounts payable instead of a decrease here. An increase in a liability means that you borrowed money, so that's cash coming into the company. So let's take a look at these items. First, we're going to our receivables, inventory, and prepaid expenses. We take a look at the difference between those items there. And let me go to my Excel sheet here. And we see here where we had a prior year balance of $50,625. Current year is $65,810. Let me make sure I'm dealing with the right problem. Yes, I am. Been doing so many videos today. I want to make sure I got the right one here. So there was an increase in the accounts receivable balance. An increase where my current assets are concerned represents a decrease in my cash flow. So I want to take this $15,185. I'm going to go back to my problem. This increase in accounts receivable would be a negative 15185. Next item that we have here, well, I'll just go back to the Excel. We have a $23,856 increase in inventory. That's a negative number where cash flow is concerned. Here's the rule that we're looking at. Well, let me just go over here and copy it because I know I already wrote it on this side. Don't pay attention to those numbers. That was from another problem. Let's go get the little rule here. So what's happening? Anytime we have an increase in current assets, that would show up as a decrease in cash flow. And okay, I'm being OCD here, but there's a space between there that doesn't belong. Okay, anytime there's an increase in current assets, we would find it to be a decrease in cash flows. A decrease in cash flows is an increase in a decrease in current assets is an increase in cash flows. When it comes to liabilities, it's going to be the opposite of that. They go in the same direction. An increase in current liabilities represents an increase in cash flows. Decrease in current liabilities, we're paying those down, so that's a decrease in cash flows. So this is the little rules that you want to follow. These are the rules that you want to follow here. Going back to our inventory, that's negative 23,856. The prepaid expenses, when we get to cash flow statement, because it's a decrease here, it's going to be an increase. Let's get to the right number here. So we had an inventory increase. And inventory increase is a negative 23,856. The next item was the prepaid. We had a decrease in our prepaid expenses. So that represents a positive cash flow. Okay. Then we went to the liability section. We actually had two short-term liabilities that showed up here. Let's go here. We have accounts payable, and then a short-term note payable. But I want to highlight something for you here. Accounts payable is a current liability, and it belongs in the operating activity section because it's a part of our normal operations for doing business with our suppliers. The short-term note payable, however, even though it is a current liability, it is not an operating activity. Anytime we're talking notes payable, we want to kick that down to the financing activity section. So the only current liability that applies here in the operating activity section would be our accounts payable. Flipping back to our spreadsheet, accounts payable decreased by $61,534. So that's a decrease in our cash flow. We paid that balance down. Decrease in accounts payable. So that is $61,534. Okay, we end up here with a net cash provided by our operating activities in the amount of $40,900. Okay, so from our regular business activities, we're saying cash came in, a net balance for cash was provided for us in the amount of $40,900. Moving on to the investing activity section. Typically for this one, we want to look at what changed with regards to our long-term assets. And we had some equipment changes here, but honestly, anytime we see that, we're going to need to look at the additional information because we can see a change there and not really totally understand what happened without the detail. Because we can sell it for something, we got to know the book value and figure out whether or not there was a gain or loss, and all of that additional information is given to us here. In reality, you've got to go look at some sales documents and compare that to the values that you were showing on the books for those particular items. But loss on the cash sale of equipment, this one we actually handled in the operating activity section. We just added that item back in. Item B says that we sold equipment that cost us $46,875. They give us the accumulated depreciation. But honestly, what we're looking for in this investment activity section is how much cash was involved. That's all I want to know. So the $11,675, I sold equipment. So this is money coming in. So this would be the cash received from the sale of equipment, and this is going to be for $11,625. See what else might impact our investing activities section. Remembering that investing activities are the purchase and sale of any long-term assets. And that's like property, plant, and equipment. It could also be purchasing stock in another company, just holding it for investment purposes. Item C, we purchased equipment costing $96,375. We paid $30,000 cash, and we took out a long-term note for the balance. We're always looking for, is it operating, investing, or financing? And then I want to know how much money was involved. Did the money come in? Did the money go out? This is investing. There's $30,000. We paid it, so cash went out. So this would be cash paid for equipment. And this is the cash portion of this was $30,000. Now, I do want to highlight at this point, we learned in Principles 1, the Accounting 201 class, that anytime we have a note that is a significant amount, at least for that company, then there is an item that we should have at the end or the very bottom of our statement of cash flows, and this would be non-cash items. This is actually one of those things that should show up here. They don't talk about it in this chapter, but at the very end of this cash flow statement, there could be another line here that talks about non-cash activities, and then mentioning that a notes payable was taken out. Why? And indicate the amount there. The amount would not be included in the totals here because it did not affect our cash for that fiscal year that we're measuring, but You do want to indicate it as a note because you want your stakeholders to see that there is something else here that is going to affect the cash for the upcoming year. And so anything that's significant there, we want to indicate these non-cash items. So any kind of long-term note receivable, mortgage, not notes receivable, notes payable, mortgage payable, that kind of thing we want to indicate. That was C. D is we borrowed cash, short-term note payable. That's financing. We paid $50,000 to reduce long-term notes payable. Another financing. We issued common stock, financing, dividends, financing. So we're done with the investing section. Investing section actually is net cash used in the investing activities. And this is because this is a negative number. And then we go finally to the financing activities section. And we already just talked about a few of those. Let's take a look at them again. We'll go back to D. I think that's where it started. We borrowed $4,000 cash by signing a short-term note payable. This is cash borrowed on the short-term note payable. That's an increase in cash. And again, that's from item D. We also had, for E, cash paid on this long-term note payable in the amount of $50,125. So this is cash paid on long-term notes. And that's a negative because it's cash going out. We also, the next item, we issued 2,500 shares of common stock for $20 per share. So that's a financing activity. And this is cash received from issuing stock. That's $20 per share times 2,500 shares. That's going to be $50,000 positive because this is cash coming in. And finally, we have cash paid, declared and paid for dividends, $50,100. That's a negative. This is dividends. Minus $50,100. We end up with $46,225 negative. That means this is net cash used in financing activities. Okay, what we want to do next is add these three together. The operating, investing, financing numbers, add them all together. We actually end up with a negative $23,700, and this represents a net decrease in our cash for the year. All we need to do next is go back to the top, look at the ending cash balance for the previous year, which was $73,500. Come on, move, screen. $73,500. So if I take the negative cash that was used this year, $23,700, subtract that from the $73,500, I end up with a cash balance at the end of the current year of $49,800. What I want to confirm is that this is the same as the number I have here, $49,800. If that's not the same, we did something wrong. That is that Fortin cash flow statement prepared using the indirect method. Let's take a look at the direct method now. So same information, but this time we're going to prepare the cash flow statement using the direct method. The direct method is simply where we are not going to just take a look at the difference in the items from one year to the next and use those as adjustments to our net income, but we're actually going to line by line indicate those items that involved cash. So with this one, operating activities, we're still going to start with we're going to actually start with the cash that's received from our customers. Yeah, come on. How do we get cash received from our customers? We want to go to our sales account typically, but we have to be careful because we also have accounts receivable in this company. So some of the monies that were received from our customers, the sales is the biggest piece of it, but we also have to take a look at the difference between the accounts receivable from last year to this year. So we're going to take the 582,500 and we are going to subtract the difference in accounts receivable. Excuse me. So the 65,810 minus 50,625, if we subtract that difference there from our sales number, we end up with 567,315. Next item, with regards to our operating activities, we want to go and take a look at what's happening in this company. We have inventory, and there's a change in our inventory here. We want to take a look at how much cash was actually paid for our inventory this year. And cash paid for inventory, we're going to start with the cost of goods sold number here, which is $285,000. We want to then add to that the increase in the inventory account, and then we're going to add to that the decrease in accounts payable. If there were a decrease in inventory, we'd be subtracting that number. If there was an increase in payables, we'd be subtracting that number. So we're going to do it according to what's happening. So we have our cost of goods sold here at $285,000. The inventory account increased here, and we're going to take the difference, what that increase is, add it to the 285, and then our payables, accounts payable, this number actually decreased. That decrease in accounts payable is going to be added as well. We do all of that, and we come up with $370,390. What's next here? What else would affect our cash flow in our operating activity section? We have cash paid for other expenses here. Let's see, cost of goods sold. We have these. We've dealt with depreciation and the lost. We've got some other expenses here. And let's see what other, we actually paid $132,400 for those other expenses, but we did have some prepaid expenses. We can tell that from the account that we see here at the top. So we're going to take the difference in the prepaid expenses, the 1875 minus 250, and we subtract that from the other expenses number here. So 132,400 minus the difference between our prepaid expenses up top. Cash paid for other expenses. We do the math there. This is a negative $131,775. What else do we see here? Got our other expenses. We've dealt with this loss. We've got income taxes. So we want to, we don't have any other information on the income taxes. As a matter of fact, we're going to just take this number and subtract that out as having paid that. Why don't I have an adjustment to it? I don't have any income tax payable up top. If I did, then I'd have to take a look at whether or not that balance changed from year to year and make an adjustment accordingly. But because I don't, I just want to take the cash paid for income taxes, and that is going to be $24,250. Something is missing here. Oh, my cash paid. I knew that number was way too high. That should have been a negative number. Sorry about that. So we end up with $40,900. That number is positive. So this is cash provided by the operating activities. Moving on to the investing and financing activities. This part should be easy for you. I told you that the direct and indirect methods use the same process for the investing and financing activities. So all you really have to do is take a picture of what you did in question 1 and copy that same information here, as long as you are dealing with problems that have the same numbers. If your homework problem has different numbers between questions 1 and questions 2, then you can't do that. You actually have to calculate them again. Okay, so for the investing activities, this is again, we had the cash received from the sale of our equipment. There we go. Took a minute to find that one. Cash received from the sale of equipment, that was $11,625. We also had cash paid for equipment. Because we paid it out, that's a negative $30,000. Total of $18,375 negative. So this is cash used in our investing activities. Then we go to the financing activities. We had cash borrowed on a short-term note. That was $4,000. Didn't get it all in there. We also had cash paid on the long-term note. If I'm paying it, that's a negative $50,125. I had cash received, so I know this one's going to be positive, from issuing stock, $50,000. I had cash paid for dividends, and that was minus $50,100. This is a total of negative $46,225. This is the net cash used in financing activities. We add those three items together again, and they add up to a negative $23,700. I am going to add to that the beginning balance from cash from the prior year. The ending balance for last year is the beginning balance for this year always. So $73,500. I end up with $49,800. And that's what I wanted to end up with, $49,800 here. That, my friends, is the direct method for preparing our cash flow statement. Going to stop here, and then I will, because this video got a little longer than I thought, I'm going to stop here and we'll wrap up this chapter with the financial ratios and vertical analysis on the next video.